Hello, everybody. This is Dr. Richard Smith, aka the Doctor of Uncertainty. First, more evidence of the coming crisis. We talked a lot about Ray Dalio and his views last week. This week, we're going to be talking about Peter Turchin and his new book, End Times, and his interesting research about predicting history. We're going to take a look at markets today, what's going on, what particularly is happening in the markets at this moment in time, our model portfolio review, some new portfolio research, a little bit on volatility and correlation, and then finally a great book with some great tips, best loser wins. Let's get into it. All right, so last time we talked about Ray Dalio's explanation of why markets are going up, private balance sheets are pretty good, households and businesses, because government has been moving money off its balance sheet through the Federal Reserve into the balance sheets of the private sector. Why do they do that? Because it's a last-ditch, last-gasp effort, right? After adjusting rates doesn't work anymore, giving money directly to financial institutions doesn't work anymore, and now we got to give it directly to the private sector, households and businesses, to see if they can get the economy going. So we continue to be in this MP3 monetary policy 3 regime, right? Anybody remember the great financial crisis when we thought this, $1 trillion of increase in the Fed's balance sheet was absolutely inconceivable? Meanwhile, it trickled up over the next 10 years, and then we hit the pandemic, and boom, doubled again. So instead of 2 trillion back in 2009, we're now at 9 trillion and coming down, right? I don't see how we can likely have another burst up to cover, past sins. It's hard to imagine the public accepting another huge increase in the Fed balance sheet. So I don't know what MP4 looks like. I don't think there is an MP4. I continue to believe that there's a payback for this coming. We looked at M2 last week, money supply. M2 is all the cash we've got, checking accounts, saving accounts, certificates of deposit, basically the liquidity in the system. Now, this is global M2, not just in the US. So the US is here in dark blue, right? So we've got all this M2 and it's been going down and now it's negative, right? But we looked last time how it was at unprecedentedly high levels, and this is still on the balance sheets of the private sector, of households and businesses, and it's being spent, but it's going down now, right? It's dissipating. It's gonna run out, and that continues to today. There's been some recovery in M2, but again, it's hard to beat this Act 3 here, which came on the heels of Act 2, which came on the heels of, earlier acts. So that's still the boat that we're in. So I got this email this week from John Malden, Thoughts from the Frontline, and it had this headline, "The Science of Cycles with a Big Picture of Uncertainty." And I said, man, this guy is talking my book. What's he talking about? The Science of Cycles and the Doctor of Uncertainty, right? So I said, got to look into this. And it turns out what he's talking about is Peter Turchin and his new book, End Times. Peter Turchin is he was a biologist, and he studied complexity science like I did. And then he started to apply it to history to see if he could model history as a dynamical system and use that dynamical system, that model, to predict what might happen in societies and look back at, if it predicted correctly, things in history. And he's had some interesting results. He spent time at the Santa Fe Institute. He's collaborating with them. I worked with Santa Fe Institute in the past too. And some mixed feelings overall about the big picture of his work, but there are a couple of undeniable things that my research into Peter's work showed me over the past couple of weeks, and I'd like to share with you. And a closely related book is Deaths of Despair, and you'll see why we're going to talk about that as well. So the basic idea of Peter Turchin's thesis is that something he calls the wealth pump. And the wealth pump is not a good pump, okay? It's a wealth pump moving money from the have-nots to the haves. And right, Ray Dalio was talking last time about the great wealth transfer. So declining population well-being and growing popular discontent, okay? We're going to see evidence of that is what's happening and has been happening for decades now. And then the second part of this is elite overproduction, intra-elite competition, and conflict. So pretty simple model. And let's get into the data and see if it holds together. So here is a chart. Interestingly, in Turchin's whole book, which is supposed to be about the science of history, there's not a single chart. But digging into his work online, looking at how others have followed up on his work, there are a lot of charts and a lot of data. So what we're looking at here is GDP, gross domestic product, in the United States going back to 1980, okay? And we can see the GDP has increased, doubled since 1980. And then down here, we have real wages for salaried workers 16 years and over. Okay, so wages have not increased. Meanwhile, gross domestic product for the country has increased and significantly. So this is a huge gap, right? The country's doing better on the whole, but workers aren't feeling those gains. And most of the gains in GDP are not going to workers, they're going to managers and corporation owners. Okay, they're going to the consumers of labor. We have labor down here, and we have the consumers of labor pocketing the difference between the growth in GDP and the lack of growth in wages. So Peter has taken this data, and this is real wages divided by GDP. Okay, so if it's going up, it means wages are going up relative to GDP. If it's going down, it means wages are going down relative to GDP. So, oops, let me go back. So here we have 1960 right here, all the way into 2010. So about 50 years. And we see that wages have been declining relative to GDP, right? GDP has been going up and wages have not been going up as fast. So wages have been declining relative to GDP. And this is, uncomfortable for working class people. This is average life expectancy in the United States, having a sharp decline from about 78 years to 76 years, the first time in over 100 years that we've seen a decline in life expectancy in the United States. And by the way, these are other developed countries up here outliving us, even though we have the highest healthcare costs in the world. And we're experiencing sharp declines in life expectancy, especially among the working class and those without a college education. It's hitting females and males. So females' life expectancy declining, males' life expectancy declining even more. These are by race. So smaller declines amongst Asians, significant decline amongst Hispanics, but still outliving whites. Pretty big decline amongst blacks, and really tragic decline amongst indigenous peoples, Native Americans and Alaskans. So this is real. Things are not getting better for the average American. Getting back to the other book, Deaths of Despair, This is particularly among U.S. white males. These are both Princeton academics that did this research and wrote this book. Drug-related deaths going up, alcohol-related deaths going up, suicides going up. They also highlight life expectancy, and this was before COVID and the big decline in life expectancy, but life expectancy flattening, and then as we know now, declining in the United States. Deaths of despair, okay, suicides, drug overdoses, alcohol-related deaths going up, especially among white males in these age groups, across the board, right? And the younger people in particular, while the older people, not as much. So there definitely is growing popular discontent across the board. US white males here, deaths per 100,000 going up. Meanwhile, deaths per 100,000 going down in the developed countries, but not among particularly US white and US white males. So Turchin's term for it is popular immiseration, meaning misery, okay? Creates a powerful incentive for commoners, the workers, to escape by moving into the elites, right? Which has really pushed everybody into the universities, taking the credentials route, trying to get into the elites through a university education. 1950, actually I have some data on this. These are number of college graduates between 1971 and 1999. It's gone up since then. But 1971, we had 840,000, I guess, and by 1999, 1.2 million, so a 50% increase. This is by year, so who knows what it is today. But clearly, a lot of people going to college to try to escape the tragedy of the non-college educated working class in the United States. It was economically, advantageous, and it still is, to have a bachelor's degree over the lifetime. You can earn an extra $300,000 if you get a bachelor's degree. But while most bachelor's degrees programs in engineering, computer science, economics, and nursing increase lifetime earnings by $500,000 or more, most programs in fields such as art, history, music, philosophy, religion, psychology leave students financially worse off than if they had never gone to college at all. So the payoff of a college education is decreasing. All right, so let's just sum up the key observations of Turchin here, right? Declining population well-being and growing population popular discontent. We've certainly seen that. Elite overproduction and intra-elite competition, right? More people trying to enter the elites so that you escape the, the decline in well-being and you escape the discontent. But that leads to a lot of competition between elites. He has lots of evidence that in past societies, these structural conditions usually ended with major outbreaks of political violence, revolutions, and civil wars. Back in 2010, he was predicting we'd see this kind of instability in 2020, but we are now in the midst of that crisis, but still have the opportunity to navigate outcomes. So that's the basic idea of Turchin's work. It lines up a lot with Neil Howe's work, which we've talked about a little bit. The fourth turning is here and does continue, to me, to give compelling evidence that all is not well in Denmark, in the United States. So we've got a lot of debt, right? We've got generational conflict that we're in the midst of, and we've got declining well-being amongst the majority of the population, declining economic health, and too many people with college degrees without enough jobs to go around. starting to use their educational skills against each other in intra-elite conflicts. And what did we have this week? Evidence from U.S. job openings declined to 8.83 million, lowest since early 2021. That was this week. What Bloomberg Economics says, labor market data through July shows just what the Fed wants to see: slower job growth and a still low unemployment rate as excess labor demand dissipates. So the Fed is trying to dampen demand for labor, right? But we've seen that wages have not been rising, even though the prosperity of the country as a whole has been increasing. So, do we really want to be dampening wages right now for workers when what we probably should be doing is helping to mitigate the gaps between the haves and the have-nots in order to have a healthy society? What did the stock market do when that data came out on the 29th? Rocketed up. Boom. These are hourly data bars on the futures contracts. Hey, pressure on labor. Wages likely to slow down. Wage increases likely to slow down. Let's celebrate in the stock market. Why? Because the owners of financial assets consume labor, right? So stock market goes up when labor costs go down. That's been going on for a long time now. It doesn't appear to me to be a sustainable model. And it's something that we have to continue to keep an eye on. And I think it's more evidence that the system is badly broken and that it's going to get worse before it gets better, right? We are going to continue to see conflict. We're already seeing conflict. The pie is shrinking. And not enough people are participating in the pie already, and then the shrinking pie makes everything worse. So I continue to believe this is what we're facing. This is what lies ahead. This is what we have to be preparing for, seeing it coming. This is from a few years ago, but still relevant today. Many adults would struggle to find $400 the Fed fines. 4 in 10 American adults wouldn't be able to cover an unexpected $400 expense. It's not okay in the United States of America. It's just not okay. A little more from Peter Turchin here. This is political violence database. I haven't been able to actually see the data on this. I have to take his word for it. But every 50 years, you see spikes in violence, 1870, 1920, 1970. Lines up very well with Niels Howe's, a generation, 20 to 25 years, and seeing, unrest every second generation in particular, right, into today, the fourth turning. So, yes, we should absolutely expect more conflict, more division, less cooperation. And those aren't good indicators for digging ourselves out of a huge hole, which is putting stress on everyone. All right, quick peek. What's going on in markets today? We're moving into the month of September, which seasonally is the worst month of the year. Going back to 1950 here, right? This is just the average monthly return since 1950. September really stands out like a sore thumb here as having the worst returns of the year on average since 1950. We can look at a little. Here's since 1950 is here in the month of September. Here's the last 20 years, and here's the last 10 years. So it's been getting worse. Returns in September. It's the worst month of the year in the stock market, period. I fully expect that there is a very high chance of a significant correction in the month of September, leading into October lows. And I'll get into that a little bit as we proceed. What else is happening? We've had a little shift in the yield curve. This is 10-year minus 2 years. Okay, so We know that the yield curve has been inverted, right? So normally you'd expect longer term bonds to pay you more interest than shorter term bonds, but that's not the way it is right now. So 10-year bonds should pay more than 2-year bonds in yields, but they don't. And they haven't since back here in July of 22. And they bottomed in March, February, April of 23. And we're starting to see that normalize, okay? So it's not as bad as it was 6 months ago. The reason I'm highlighting that is because usually it's when you start to see this normalization, okay, that the problems start to arise, that the recessions start to show up. And so this normalization of the yield curve is something to keep an eye on. And it usually indicates that there's some trouble brewing, because the thing that kind of relieves the shorter term rates is when we do see crises and people want to sock their money away into longer term safe investments. So the normalization of the yield curve is usually not a good thing, indicating recessions ahead. And I continue to suspect that we will see recession sometime in the next year. This was an interesting story. Retailers lose billions to inventory shrinkage. That means theft, okay? Shoplifting and theft, going back to Peter Turchin, right? And popular discontent. 2021, $94.5 billion in losses due to retail theft and shoplifting. And it's gotten worse, right? 2020, 2021. And in the latest earnings from the retailers, they were talking about it openly, that it's not getting better, it's getting worse. And this is not good. This is not a sign of a healthy society. So, really interesting chart here as we move into thinking about, well, what do the next 10 years look like? How do we respond to what we're seeing? I believe, and this was also echoed by a talk I was able to be a part of with Neil Howe of the Fourth Turning, that the theme over the next 10, 20 years, the next couple of decades, in Neil Howe's words, is rebuilding the real world. Now, we may have to continue to see a breakdown in things over the next couple of years, but this theme of rebuilding the real world, building real things, I believe is the most compelling investment theme for the next couple of decades. And this chart highlights real assets versus financial assets. So when it's going down, okay, it means that financial assets are getting more valuable. And when it's going up, it means that real assets are getting more valuable. And I want to particularly draw our attention here to the era of the 1970s, when we had our war on inflation, which I think is what we're in the midst of again today. Real assets were much more valued than financial assets. So here we are down today. Financial assets are at an all-time high relative to real assets. And I don't think that can last. So I am interested in real assets, things that are going to resist inflation, which financial assets will not. And frankly, I think most big technology today are really financial companies in disguise. So big tech and big finance and just technology and financial assets in general, I believe, are going to decline relative to real assets over the next 10 to 20 years. Just as a case in point, this is defense spending relative to GDP, okay? So this is defense spending divided by GDP, okay? So we are today at I don't know if this is an all-time low, but it's an 80-year low in defense spending relative to GDP. This is not likely to keep going down, especially in the face of rising conflicts across the globe and involvement by the United States. So investing in the real, rebuilding the real world includes defense. And I just pointed out here as an illustrative opportunity of where I think the real opportunities lie again over the next couple of decades. So going to take a quick look and jump over to our model portfolio here that we've been tracking and building in Finiac. And this portfolio, which consists of these 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 assets. Okay. Like to continue to get that up, get some more assets in there. Ray Dalio famously called Holy Grail portfolios 15 to 20 good uncorrelated return streams. So we're up to 11 now, and this portfolio is doing exceptionally well. We've built it based on finding out what great investors are investing in, and then looking at how to put together a portfolio of those investments that are uncorrelated with one another, that and that support our themes of rebuilding the real world. So risk efficiency here, we compare it to the S&P 500, more risk efficient than the S&P 500. Let's just look at growth, okay? Growth outpacing the S&P 500, outpacing the Dow, not outpacing the NASDAQ, but doing better on a risk-adjusted basis than the NASDAQ. If we go back here to risk efficiency, right? The portfolio is beating all of the indexes in terms of its ability to convert risk to reward. So in addition to being content with how this portfolio is going, we talked about the new 13F filings that were released a couple weeks ago. And I've been doing some research to identify great stock pickers. So I went through all of the 13F filers and I looked for the ones that had 10 to 75 holdings. 50% of their holdings were in the top 10 of their portfolio. So they had concentration and conviction. The average holding period was at least 3 years because I want stocks that I can hold for a while. And the 3-year performance was at least 10% annualized over the past 3 years, which was pretty good over the past 3 years, right? And I do want that volatility to be a little higher than average, right? Because I want stock pickers, not just people that are trying to match the indexes. So with that criteria in mind, I was able to find some asset managers that I think are worth taking a look at. So Shaw Capital Management, Fairholme Capital Management, Old West Investment Management, et cetera. This is the list. Okay, I'm going to jump back over here now to the web. This is Whale Wisdom, and this is free. You can put in any of these asset managers on Whale Wisdom, and you can see what's in their portfolios. So Fairholme Capital Management, St. Joe, company I was invested in for a long time. What's in their portfolio? Old West Investment Management. What's in their portfolio? Okay. So by gathering these investments, turned out to be about 150 investments that were between, say, I think it was about 10 billion in market cap and 100 billion in market cap. I was able to put those all into a collection in Finiac here. So here they all are. I did a bulk import. It took me about 5 minutes. Just copied the tickers and pasted them into Finiac and got a collection here. And then I can, again, look at them relative to the portfolio that I'm building. And I can sort them by correlation here. And I can go down into the kind of sweet spot here and start looking at uncorrelated, minimally correlated assets to my existing portfolio. I'm also looking at the histograms here because I want ones that are relatively normal. I don't want crazy right now. I'm feeling pretty conservative in light of everything that I see coming. And I can then look into these, 10 stocks or so and see if there's anything that catches my eye. And one did in particular, and that was Southwest Airlines, right? Southwest, a lot of brand goodwill there. They've taken a hit, but not a company that's likely to be going away anytime soon. Pretty decent histogram here, minimally correlated to my existing portfolio. So now I can go back here. Here's my existing portfolio, right? And then I can look at what happens if I add Southwest Airlines to this portfolio. So we're recalculating the top line stats. Lowered the risk efficiency a little bit, lowered the volatility a little bit, increased the diversification. This is really important. I'm always looking for things that don't impact, don't really increase my volatility, don't really hurt my risk efficiency very much, and increase my diversification. That means I'm getting the same reward for less risk. And that is my big goal in my portfolios. And then I'm picking stocks and investments that smart investors are investing in with their own money. It's as simple as that. So we'll continue to build this portfolio in the weeks and months to come until we get it up to 15 or 20 good uncorrelated assets that are helping us to rebuild the real world over the next couple of decades. And it's a work in progress, but I'm excited about the direction it's going, and I'm excited about how well it's performing. So getting into just a little bit more about markets over the next month. This is my cycles analysis on the S&P 500 using daily data. Continue to expect to see a decline into late September at least. And the four top cycles here, all added together, continue to indicate a downward tendency in the S&P 500. Doesn't mean it has to happen, but we've got weak seasonality in September. We've got the cycles leaning negative in September. And we have market breadth also not doing very well. Don't have data to show you on that right now, but trust me, it's just a few stocks leading this market. It's not a healthy condition of a lot of liquidity flowing into the markets, and there is considerable cause for concern. All right, wrapping up, I want to just share with you a little book review, The Best Loser Wins by Tom Hougaard. This is a book that I wish I would have written myself. I think the title says it all. The best loser wins. Successful investing and trading is ultimately about being a good loser. And the reason that most people fail is because we're terrible losers, right? We hold on to our losers until they destroy our portfolio, and we don't hold on to our winners. So just like me, Tom Hougaard has been in the markets for a couple of decades and had the simple observation that, man, if I had only done the opposite of everything I've ever done before now, I'd be a rich man. Okay. So he has encapsulated that into just a few sentences, which I'm going to share with you now. This is Tom's mental philosophy for being in the markets. I assume I am wrong until proven otherwise, right? How many of us go into the markets assuming we're wrong? No, we're usually like, oof, boy, I did a great analysis here. I'm feeling good about this. I'm going to prove myself right. That is a setup for failure. Tom does exactly the opposite. I assume I am wrong until the market proves me otherwise. Okay. If you go in assuming you're wrong, it's a lot easier to get out of that trade, right? Than if your pride somehow has a stake in the outcome of, wiggles in the market. I expect to be uncomfortable. Another really great lesson. Expect to be uncomfortable. If you're doing the right thing, you should expect to be uncomfortable, right? Yes, it's uncomfortable holding on to a big loser, but you know what? It's even more uncomfortable holding on to a big winner and letting our profits blow away our expectations instead of our losses, right? There's something, we can be resigned to big losses. Yeah, I kind of knew it was going to happen. Dang. Oh, well, there it goes again. Holding on to a big winner and just letting it run is the most difficult thing to do. You should expect to be uncomfortable. You should look for situations that feel uncomfortable and look for opportunities in those situations. Lastly, I add when I am right, and I never add when I am wrong. And the market is defining right and wrong here. So great advice from Tom Hougaard. Lines up absolutely to a T with my own experience. I love how he's put it here so simply. Really highly recommend his book. And 90% of market participants lose, 10% win. And of that 10%, only a small portion win big. So careful out there. Please don't put your head in the sand about the signs of discord. Peter Turchin's previous book was called Age of Discord. There are real, tangible signs. This is not just, crying wolf. We do need to be careful. We need to figure out how to help right the ship, right? Not just make bets that are going to keep us out of trouble. We certainly do want to do that, right? We don't want to get in trouble, but we also want to contribute to how to right this ship. How do we help everybody? How do we get the tide rising so that all boats rise and not just ours or not just the elites? We've gotten ourselves into this mess. We can get out of it. It's going to take patience. It's going to take foresight. It's going to take good crisis management. Have a great couple of weeks, everybody. See you again soon. Stay safe out there. Thanks for listening.